Okay, well, welcome back. This is module number 5, and in module number 5, we are going to be focusing on financing options. So we'll take a look at what I consider to be conventional financing in lessons number 1. Lesson number 2, we'll talk about non-conventional financing, and then we'll wrap things up with lesson number 3 being focusing on vendor take-back or seller financing, both the same thing. So let's take a look at finance options first of all. We have the banks or credit unions. We also have mortgage brokers, and these are what I would consider to be your conventional lenders. Those are what most people would focus on going to the local bank or their mortgage broker to acquire financing for any purchase, whether it be their personal residence or a investment property. We then also have personal cash, which includes lines of credits, or retirement funds, and the retirement funds in Canada we call them the RRSPs. In the United States they're called the 401s. We then have joint venture partners as well as private money, and this is what I would consider to be non-conventional financing. So for today what we're going to do is we're going to focus on the conventional. So when do you use non-conventional if that's the case? Well, if, for example, you have a limited down payment or availability to cash, then you're going to have to go the non-conventional route, or if you also have a poor credit score. Poor credit scores would be anything under 600, 650 really, realistically, could put you into the category of having to use non-conventional financing. Also, if you've just moved to a new location and you don't have a job yet, or you've just got a job but you're still you haven't been settled in for very long, then the banks prefer that you have a contract, a full-time job. They want things to be nice and secure. Also, credit ratios not being in line. So if you owe too much money on other debt, then the banks don't like that. Therefore, you would have to go towards the non-conventional route as well. Sometimes if you want to refinance quickly in order to access the instant equity in a property, you would have to go through the non-conventional route as well. And definitely if you're looking at no money down or 100% financing, you're definitely not going to be using any of the conventional lenders for this type of financing. So these are the different ways that you would end up going the non-conventional route. Everything else you're going to be looking at using the conventional route, and you're looking at the big banks. So in the US market you've got JP Morgan Chase, Bank of America, Citi, etc. There's lots of big banks down there. In Canada there's the 5 big banks, which are the RBC, Bank of Montreal, CIBC, Nova Scotia. Now all of these big banks are very heavily regulated by the federal governments, and they have to follow these rules. They can't deviate from these rules at all. They're also owned or controlled by shareholders. So these big banks, they operate with the mandate of creating a profit for their shareholders. So you want to make sure that you understand that you're not going to get any big breaks from the big banks, because you are not their primary interest. Their primary interest is the shareholders and generating a profit for their shareholders. Now, the nice thing about the big banks, is that they operate across the country and they're recognized globally as well. So whether you are a Canadian investing in the US or a US resident investing in Canada, there are some banks that go across the borders, and these are the banks that you're going to want to focus on. It's also easier to use for these deals when they're not in your backyard, as I just mentioned. Now, credit unions are like a bank. They look like a bank. They operate like a bank. Some of the credit unions I've just written down here. There's a lot of credit unions across North America. And a credit union, they were basically started back in the days when the farmers the remote farmers would get together and they would pool their money together to lend to each other and help each other. The small communities started to create their own banks. So these banks are what we call a not-for-profit operation, and they're owned by the members of the bank themselves. Because of that, they're able to keep their costs down. And the challenge is that they're much more localized. So you could have In your region, you might have 4 or 5 credit union banks, all of the same name, different branches, but you go to a different state or a different province, and that credit union is no longer applicable. They can't help you out there. So definitely more localized, and they also offer fewer services as well. But as a result of being offering these fewer services, they also have lower fees. Therefore, when you invest your money with the bank in the savings account, you can typically get higher interest rates than the big banks as well. Another nice feature is that because they're not as heavily regulated as the big banks by the federal government, they're able to create a lot of their own policies internally. Then you've got your conventional debt service criteria. This is something you're going to want to become familiar with. So there's the gross debt service, and the gross debt service is calculated by taking all of your annual mortgage payments plus the property taxes related to the property. You divide that by the gross family income. So this is for, say, a single family house. Now, this 30% is the target you're looking for. If it's above 30% ratio, that's bad. You're not going to qualify for a loan. So what the banks want, they want to see it below 30%. So that's just something to keep in mind when you're acquiring debt. Then there's the total debt service. The total debt service is similar to the GDS, except it includes all of your other debt payments as well. So this will include credit cards, car payments, etc. And for this one, what they do is they allow you to go up to 40% of your income. And if it's higher than 40%, again, the banks are going to decline you. And if it's lower than 40%, then that's what they're really looking for. So then you have your debt coverage ratio as well. So the banks want to make sure that there's enough money to pay the debt, is what they're basically looking for. So they're going to take your net operating income, and they're going to divide that by the debt service, the principal and interest payment. Now your net operating income is all of the income related to the property, less all of the expenses related to the property, but not the debt service. If you have a ratio of 1.2 or lower, then the bank's not going to like that because they feel there's not enough room there to cover the debt service. It's just a little bit too risky. So what the banks are looking for is they're looking for 1.2 or higher. So again, that's just something to keep in mind when you're looking at all of your debt numbers. All right, so a real estate brokerage. It's a licensed brokerage, and real estate agents work for the licensed brokerage. So why am I talking about this? Well, it's the same with the mortgage broker and their agents as well. So when you do business with a mortgage agent, you go into the mortgage company and you sit down with an individual. Unless they're the owner of that company, you're actually working with an agent. You're not working with the brokerage. The agent is representing the brokerage. So you just need to realize that the agent, much like the real estate agent, is not as legally, well, they are legally committed and responsible, but they don't have the same responsibility as the broker or the brokerage. Now, inside the mortgage brokerage, you're going to have agents that are going to specialize in different things. The vast majority of the agents are going to focus their attention on residential mortgages. You will have some mortgage brokerages that focus just on commercial and or private lending as well, but they are very few and far between. Now, even within a conventional mortgage brokerage, you're going to have agents, the vast majority of the agents are going to be working with residential clientele. I would be surprised that in an office of 50 agents, more than 5 of them have done any commercial lending. The vast majority of mortgage agents focus just on the residential because the stats show that 95% of the mortgages that are created every year are residential mortgages, mortgages on houses. So why would an agent want to focus all their time and energy on commercial mortgages when there's only 5% of the mortgages out there that are commercial? So you just need to be aware that not all not all mortgage agents are going to be the same, just like not all real estate agents are the same as well. It's the same thing in the real estate industry. When 95% of the business is residential, then you can assume that 95% of the real estate agents are going to be focusing just on single family homes. Therefore, to find a mortgage agent with the knowledge and expertise in commercial lending is going to be a little bit of a challenge, similar to when you're looking for a real estate agent with that type of experience as well. Now, the nice thing about mortgage brokerages is that they have access to many lenders, and they have well over 50 different lenders available. And these are different quality of lenders as well, including your A and B lenders. But they also include, here in Canada, you could go to a mortgage broker and end up with a mortgage through the Bank of Nova Scotia, even though you've gone through the mortgage broker. It's the same thing in the U.S. market. If you go to a mortgage agent, they can set you up with one of the big banks as well. And quite often you'll get as good, if not a better rate than if you went to the big bank. So you need to be aware that they've got access to all of these different lenders. However, this is the little unknown fact that a lot of people don't realize, is that the agents are going to focus on the top 3 to 5 different lenders. Unless they get something really unique and strange and they have to start looking for different lenders, every mortgage agent is going to have their favorite go-to lender. And some of that is going to be dependent upon the deal that you bring to the table, and they'll decide whether it's lender A, B, or C is the best lender to go to, and that's all good and fine. Unfortunately, not all lenders pay the same commissions. Some lenders, in order to entice the mortgage brokers to bring them business, will pay them a higher commission in order to attract business. So it's not always in your best interest, but the mortgage broker or mortgage agent may direct you to a lender who's, it may or may not be good or bad for you, but you just want to make sure that when they do direct you to a different lender because they're getting a higher commission, that it's not going to be a detriment to you. Now, the mortgage agents are paid their commissions from the lenders for the residential. But when it comes to the commercial, that's a different story. Most commercial lenders do not pay out commissions. If they do, they don't pay out enough to satisfy the mortgage agent, so they will be seeking an additional commission from you, the client, as well. Now, when they're dealing with private lenders, a mortgage brokerage and or a mortgage agent can have a pool of private lenders, and these private lenders are going to be high net worth individuals, meaning that they are accredited individuals, and they'll have access to their money, so they'll represent the investor. It'll be like a go-between between the investor and yourself. Now, when the mortgage agent brings these individuals into the equation, you can expect to pay much higher returns than average. And you're typically not going to be approaching private lenders for funds unless you have been denied with the conventional lenders. And if you've been denied with the conventional lenders, but the property is such a good deal, you can justify paying higher rates, then this would be a route to go. Because with a first mortgage, as an example, you can easily expect to pay 1 to 3% higher than today's rate. So if today's rate is 3%, then you can pay as much as 6% for a first mortgage. If it's a second mortgage, you can go up as high, into 10 to 12%, and then your third mortgages can go to 14 to 20%. Again, there's nothing wrong with these fees. There's nothing wrong with using this service if the property or the transaction actually justifies it and is lucrative enough to do that. I personally have used private money on some deals, and I've paid 12% interest. And while I was paying the 12% interest, I was actually losing money, but it was short term. It ended up being almost a year, but the deal was so lucrative that at the end of the year, when I refinanced it to the conventional rates, I was able to realize a very healthy profit, which justified that high interest rate of 12%. You can also expect to pay some upfront fees as well. The 1 to 3% there is also called points. So if you hear somebody saying, yeah, you're going to need to pay 2 points to get this money, that means you're going to have to pay 2%. So for example, if you were borrowing $100,000 in a first mortgage at 6% interest, well, that's what you're going to have to pay on the interest side. But you may also have to pay 2 points up front, which means $2,000 as a fee to the lender. Then the mortgage agent, they're also going to want their cut as well. And their fees can be anywhere from 1 to 4% of the money that's borrowed. So If the mortgage agent is being paid 3% and the lender wants 2%, that's 5% or 5 points up front that you have to pay just in order to get access to that $100,000. So all of a sudden the $100,000 is now costing you $105,000 when you pay it back. Now when you go to qualify, quite often they will ask you to do your credit checks, and the whole process is very similar to banks. However, they can choose whether they will do 75, 85, 95, even 100% financing. That's entirely up to the lender and the mortgage agent to determine on the quality of the investment. For myself, for example, I was able to do 100% financing on my transaction because the lender saw that the overall value of the property was much greater than the price I was paying. So he felt very, very comfortable lending me 100% financing on the purchase price, seeing that there was probably it was probably still only at 60% loan to value. So if the value is still there, they will do the 100% financing. Just keep in mind that the more money, the higher the higher not the interest rate, the higher the percentage that you want to borrow. In my case, 100%. Then they're going to want to charge premium rates. Now, you also need to be aware that the Dodd-Frank Wall Street Reform and Consumer Protection Act was put in place in the U.S. market back in 2010 to regulate the lending of money. So this may or may not impact you depending on who you're borrowing the money from. Just be aware that you need to follow these rules, and the mortgage brokerages need to follow these rules very, very closely. And that's why this act was put in place, was because after the 2007-2008 mortgage meltdown, there was a lot of very unethical practices taking place. So they had to step in and put some new rules and regulations in place. So that's a little bit about the financing. If you have any questions, again, we will be doing the live Q&A at the end of this module. But if you can't wait, please feel free to email me at kbeaton@arcarealestate.ca, and I'll be happy to answer your questions. All right, thanks very much, and look forward to seeing you in lesson number 2.